Welcome to The Explainer. Today, we're exploring what might initially sound like a wild, totally counterintuitive idea, but is actually a fundamentally lucrative private equity and private lending opportunity. We're looking at the mid-market logistics sector in the Odessa region. Now, you might be thinking, logistics platforms in an active conflict zone? No way. But as you'll see when we actually dig into the data, for disciplined investors who are actively hunting for high-yield frontiers, this is a uniquely compelling thesis. It's built on massive cargo flows, incredible founder-led resilience, and some classic valuation arbitrage. Okay, let's dive into this. We're structuring today's explainer a bit like an investment committee memo. We'll start with the core Odessa investment thesis, then define the mid-market sweet spot. After that, we'll hit the market growth drivers, look at real mid-market targets, discuss mitigating risk, and wrap up with execution and valuation. I want to hit you immediately with this massive figure, 97.2 million tons. That is the total cargo handled by Ukrainian seaports in 2024. Let that sink in for a second. Despite the severe conflict, restricted airspace, and frankly unbelievable geopolitical volatility, this market is actively scaling. The sheer physical volume of commodities moving through this region completely defies all those standard assumptions we make about wartime economies. So, moving to Section 1, the Odessa investment thesis, gateway to the Black Sea. It's absolutely crucial to understand that through our investment lens, Odessa isn't just a local city market. It's the structural gateway for virtually all of Ukraine's maritime trade. It's a massive funnel. And this brilliantly illustrates the macro momentum supporting our thesis. Look at that recovery. In 2023, amidst intense blockades, the region handled 62 million tons. Fast forward to 2024, and that throughput surged to 97.2 million tons. For a private equity sponsor or a private credit lender, this is exactly what you want to see. It's a market that has already stress-tested its absolute floor and is now riding a massive, sustained year-over-year operational rebound. To get a bit more granular, let's look at exactly where all that volume is flowing. Just in the first quarter of 2025, the greater Odessa ecosystem moved 20.7 million tons alone. Notice how Port Pivdeny is the absolute heavyweight here, commanding 10.6 million tons, followed by Chornomorsk at 6.6 million and Odessa Port at 3.5 million. The takeaway? Any logistics platform physically adjacent to or deeply integrated with these specific terminals commands a massive strategic premium. Which brings us to Section 2, the mid-market sweet spot, defining the target niche. We know the macro volume is there, right? But where do we actually deploy the capital? Well, it's all about where we focus our lens. On the left side of the market, you have the bulge market. These are your state-owned rail monopolies like Ukrzaliznytsia or global giants like Maersk. They set the rules of the game, sure, but they are completely unacquirable for a mid-market fund. We want to ignore them and focus entirely on the right side, those agile, founder-led companies doing roughly 10 to 50 million US dollars in revenue. We're talking about firms with 10 to 30 years of operating history that act as the vital connective tissue between the ports and the cargo owners. For PE buyers, obviously it all comes down to underwriting guardrails. So here's the baseline margin logic for this mid-market tier. Your pure asset-light customs brokerage generally yields about 4 to 8% EBITDA on gross revenue. But look at the asset-backed businesses. Warehousing and terminal-adjacent yards, they can drive 12 to 25% EBITDA, assuming you've got high occupancy. Specialized operations, like hazardous ADR or heavy project cargo, sit really comfortably in the 8 to 18% range. This matrix gives PE buyers super clear guardrails for capital allocation, entirely depending on your appetite for asset ownership. Let's move into Section 3, drivers of market growth, catalysts for value creation. If a private equity firm actually buys into this market today, what specific levers can they pull to instantly create value? The first major catalyst is absolutely the container rebound. Before the war, Ukraine was moving over 1 million TEUs, 20-foot equivalent units, annually. That totally crashed to 65,000 in 2023, but it's rebounding to an expected 320,000 TEU in 2025. And why does that matter for us? Because container flow drives significantly higher margins across customs, trucking, and warehousing compared to, say, simple bulk grain coordination. The return of containers literally means the return of high-margin logistics. Now, what's really interesting about this slide is the concept of Western compliance arbitrage. A lot of these local founder-led operators in Odessa have phenomenal ground-level execution, but they just lack institutional Western standards. So by injecting some capital and implementing basic things, bilingual sales, clean financial reporting, modern CRMs, strict compliance screening, and acquiring PE sponsor can transform a gritty regional business into a trusted partner for massive Western shippers. That's a perfect arbitrage opportunity that instantly boosts the valuation multiple. Okay, Section 4, Real Mid-Market Target Examples. The actionable pipeline. Let's step away from the theory for a minute and look at the actual companies operating on the ground right now. Here are 3 prime examples of founder-led firms that have survived literally decades of crazy market cycles. Stahls Logistic, founded in 2005, dominates specialized niches like flexi-tanks and U.S. auto imports. Zenel Ltd. has been operating since 1994, handling really tricky ADR, hazardous materials, and refrigerated cargo out of Chornomorsk. And then you have Intertrans Logistics, navigating sea and road forwarding since 1996. Their long-term survival and those deeply sticky customer bases make them absolute prime targets for recapitalization. And looking at 2 more quick examples, Alpha Trans has over 2 decades of owner-managed multimodal service history. Nova Logistics is super fascinating because they actually own physical infrastructure, a whole container yard with heavy gantry crane operations. These deeply entrenched owner-manager structures, especially for firms founded back in the early 90s or 2000s, are massive flashing signals for succession opportunities. The founders are likely tired and might be looking for an exit, or at least a strong capital partner to transition the business. Which naturally brings up a highly practical question. Since public listings for $50 million logistics firms in Ukraine are virtually non-existent, how do we actually source these deals? They aren't exactly posting ads on message boards, right? The only viable strategy is proprietary sourcing. You have to do highly targeted outreach directly to founders from that 1993 to 2012 era. And crucially, you don't just kick the door down and say, "We want to buy your company." You approach them offering actual solutions, succession capital, risk management infrastructure, and access to Western capital lines. It has to be a partnership pitch. Section 5, Mitigating Risk and Deal Structuring. Underwriting the war. For our PE and credit audience, this is arguably the most critical part of the whole explainer. We have to underwrite the reality of the geopolitical situation. And to impartially frame that reality, we look to international reporting. As Reuters noted, active military strikes targeting port infrastructure are a constant threat to these export flows. This geopolitical risk, alongside massive insurance volatility and physical infrastructure damage, is a severe, unavoidable reality of this market. We aren't ignoring the conflict. We have to structure our investments meticulously around it. Because beyond the rockets, an acquirer must ruthlessly diligence the structural business risks. We're talking extreme customer concentration, a forwarder relying on maybe just 2 big grain exporters. You have to separate gross freight billings from true net revenue. And perhaps most importantly, investors have to untangle cash leakage, informal payments, unclear asset titles, and severe labor shortages driven by ongoing military mobilization. Let's move to and see how this builds into our specific deal structures to actually neutralize those risks. Smart investors protect their downside mechanically. If a founder isn't quite ready to fully exit, you execute a minority recapitalization with a call option. If it's a full succession play, you do a control buyout, but you use a heavy founder earnout structure to tie their payout to future performance. Or you just do asset-light tuck-in acquisitions, buying out a competitor just to acquire their clean customer book without taking on the yard or fleet risks. Finally, Section 6, Executing the Acquisition Strategy, Framework and Next Steps. With all this in mind, how do we actually price these assets today? Valuations here require a very conservative, structure-heavy approach. Right now, small brokers are trading at roughly 3 to 5 times normalized EBITDA. Larger regional forwarders might command 4 to 7 times. For asset-backed fleets, you're looking at an earnings multiple plus a hard asset appraisal. But listen, the single most important word here is normalized. During diligence, you absolutely have to strip out the wartime rate spikes, the one-time rerouting anomalies, and any underreported cash just to find the true sustainable baseline margin. Which leaves us with this final, really provocative thought. 97.2 million tons of cargo are actively flowing through this region right now. The physical demand is undeniable, and the mid-market targets are mature and incredibly resilient. So the real question is, which private equity firm or which private lender is going to be the first to move in, provide that succession capital, and institutionalize Adeza's founder-led logistics network before peace inevitably returns and normalizes these valuations up to a much higher premium? It's a totally fascinating frontier. Thanks so much for joining me on this explainer, and keep looking for those high-yield opportunities where everyone else only sees obstacles.